Welcome to Alpha Talks Editors Roundtable. What moved the markets this week? The week ending Friday, July 31st, 2020, last week of July here. I am joined by Brad Olesen, VP of News, Stephen Alpher, Managing Editor of Breaking News, and our special guest, Jason Aycock, Senior Editor of Media and Telecoms. Aaron Task is on holiday this week. Okay, it's almost August, but it was a very busy week. A lot happened. We had a massive GDP report for the second quarter that was horrible. We had Fed testimony and the Fed decision. We had a bunch of earnings, and we also had still ongoing negotiations in Washington, D.C. over a fiscal package extension or a new fiscal package. Those are ongoing. Today is the deadline, July 31st, presumably at midnight. So that situation is still very fluid. Despite all that, interestingly enough, stocks did not really move all that much. A little bit. We're about flat for the S&P 500 as we record this at noon on Friday. And the Dow is down a bit. I think the tech stocks have done well, but perhaps not as well as one might believe, given the earnings that we had. So, like I said, a lot for us to unpack. Maybe let's start with Bradley Olesen to give us a little bit more background on this and tell us about the winners and losers.
So obviously this week, as you mentioned, was mostly a earnings oriented week, and so with that, we've moved away from the binary moves in the market where it's virus on, virus off, and we're now into more idiosyncratic moves. I characterize it as more of a old world, new world situation. We had Intel, which is their earnings massively underperformed after their product delay. Their stock sold off a bunch. Seagate Technology, also one of these more traditional storage, hardware storage companies, they also suffered terribly from some of these pandemic related issues. And then you had the new world like AMD, NVIDIA, these are the graphics cards makers. They did well this week, kind of capitalizing on Intel's woes. And then Boeing and GE, also stalwarts of an industrial age, they suffered this week on the back of their earnings. I guess not so much surprise for Boeing, given that most of their planes are grounded. GE was struggling. They're looking to monetize their Baker Hughes stake. This was their foray into the more traditional oil and energy plays. So a little bit of an old world, new world dichotomy with big tech, as we saw late Thursday, broadly higher on the back of Amazon's results, Apple's results, Alphabet's results, which exceeded expectations, although they did show a contraction on the top line year over year. So there was obviously a heavily earnings focused week, but one of the bigger stories I think that has led to some of the underperformance has been the rates situation. And we've seen that financials are now banks and financials were one of the worst performing sectors this week after energy. A lot of that has to do with some of the real rates situation. The 10-year yield is now hit multi-century lows this week. As Deutsche Bank's Jim Reed characterized, the U.S. has gone through depressions, deflations, gold standard regimes, market crashes, wars, and none of them pushed the yields to the situation that we're in now.
Stephen Alpher, what about you? Corporate news, and what else caught your eye this week?
I'll point to a couple of earnings reports we didn't talk about earlier. One being UPS, which unsurprisingly had a massive blowout of a quarter, which you would expect if Amazon's killing it. UPS is probably killing it too. But the
blowout in a good way. Blowout in a good way.
Right, but the market reaction shot UPS went way higher, suggesting somehow prognosticators had not figured out that UPS was going to have a big quarter, because I think the stock was up double digits yesterday after reported. FedEx was up in concert, though not as much as UPS. And I'll point to, as I like to do, something maybe a little bit under the radar, which is Ollie's Bargain Basement. They pre-announced either late last week or early this week Comp sales were up 40% year over year for Q2, or that's what it's going to end up being when they finally report, which is a crazy number. And you say to yourself, how does a big box store like that do that? Well, Ollie's, they got themselves classified as an essential business, and they stayed open during the pandemic. During the shutdowns, we're still in the pandemic, and as we're seeing with Amazon, there's fewer places for people to shop. The stores did quite well. But what's really shocking to me is in a Q2, as we know now, the economy shrank by about 1/3. But Amazon and Apple both reported record quarters. Real remarkable when you think about it in those terms.
Well, first of all, I just had to share my initial impression of what happened yesterday, because it's, I mean, investors will know, it's sort of an unusual thing for these four companies to line up like this. And at least in the soft light of the release of the earnings, the initial impression was, wow, look at these blowouts. And the first thing I thought was, what if these earnings had come right before the big high profile tech hearing where these four CEOs went up there and had to kind of stand their ground and defend themselves against the idea that they're powerful. Those hearings came first, and all I can do is think about what would have happened if they just actually held those hearings after blowing out earnings all over the place. Now, I think that things are a little more sober in the light of day as analysts took a look, because the earnings clearly did outperform. It's the kind of thing that, as Brad talked about, old world, new world. I think in the old world, a night like that would have led you to believe that Friday would be a blowout win day across the board. But there's a lot of other factors going on across the market. Analysts are taking a look at these results, and while they were strong, I feel like there's a lot of reversion to the mean in the way people are talking about these four companies, in the sense that they're saying, well, yes, things were great, but Facebook showed some deceleration. As Brad noted, Google actually contracted across the top line for the first time in their history. So when you read across reactions today, it seems like a lot of them are saying a lot of the things they're saying about other companies in the market. Things in the second half are going to depend on some macro recovery. That applies for Facebook and Google, are heavily ad dependent. And so regardless of the different ways they came into earnings, a lot of how they perform from here, there's some caution, there's some pullbacks. Of course, that has to be put in context of these particular stocks, right? Facebook is expected to guide conservatively. So yes, there'll be some more deceleration in the second half. Will they probably beat again in the second half? There's a good chance of that.
And let's keep in mind that the Fed was pretty dovish expectedly this week. So I don't know, we don't have to necessarily say that the market's ahead of itself. There's stimulus as far as the eyes can see, at least on the monetary side of the equation. And we can all say, we can also remark about the thinking that was heard around the world, right? He's now not thinking about raising rates, which is the third thinking in there. Up from two. Yes.
Yeah, so I get the sense he's not thinking about it, I guess, is the bottom line. All right, let's move on to the next segment of the show, where we discuss our favorite articles from Seeking Alpha and elsewhere that we've seen, and in some cases even edited this week. And why don't we start with our guest, Jason?
Well, you would expect me to select something about the tech earnings as my favorite story article of the week. I have to say my favorite article, the thing that's been occupying my mind today, is our coverage yesterday of Seth Klarman talking about the Fed's approach to the market and how it's infantilizing the market. And I have to say, so Klarman said that the Fed is infantilizing the market. It's created a surreal situation. He says, and I quote, "It's as if the Fed considers them foolish children, unable to rationally set the prices of securities, so it must intervene." And I got to say, the thing on my mind today is how egocentric is the hedge fund world to think that the entire context of his comments were as though the Fed's entire purpose is market-based as opposed to Main Street-based. I think other commenters have noted that the Fed isn't just there to support equity prices; they're there with a dual mandate that's related to the economy.
I have two. I'll try to go through them quickly, so it seems like one. One was I think we shouldn't go through without mentioning the action in Kodak, the old Eastman Kodak,
Yeah.
Absolutely.
which started the week at about $2.50 a share, rose to as high as $60 a share. It's currently, I think, in the low 20s. And the catalyst for that was they received a loan from or deal for a loan from the government to convert basically an idled factory of theirs into domestic generic drug production facility. And it goes to show kind of there's a number of things, a speculative fervor about and the whole COVID deal, and so it brings those two together and brings a third thing together, which is the onboarding of domestic drug production. Maybe there are other companies with other idled factories to look for in that case. The other item I saw was in our fund letters coverage. Horizon Kinetics this week had their most recent quarterly letter that's run by Murray Stahl, who in my mind is kind of legendary for picking Texas Pacific Land Trust out of somewhere a couple of decades ago, and it's basically compounded in the high teens to low 20s for Horizon investors for a couple of decades now. Stahl makes the case for that we're on the cusp or already in the return of inflation. I don't know whether I agree with him or not, but it made for a very interesting read.
All right. Bradley, what about you?
So for me, I'm just trying to keep that forward-looking view and when we can move towards normalcy. So I saw an interesting.
There will never be normal.
Not at this rate, and unfortunately for some industries, that decline will be long-term in nature. I saw the landmark release window deal with Universal from AMC Theaters, shortening the window, the exclusive period when these theaters have the rights to run these brand new movies. I think that was emblematic of the crisis that we're in. They don't see an end soon to the pandemic when we can move to normalcy, and it's shifted the power into the hands of the creators of these movies. And at the same time, we saw news that the other side of the coin, Tenet, this major blockbuster release, was normalizing a time release. So I think they're going to launch in the US around Labor Day. Jason can correct me if I'm wrong there, with an international release shortly ahead of that. So interesting in the fact that usually these US releases will launch in China or maybe the US first. International population gets first crack at this major blockbuster due to the virus situation that's unfolding. But looks like for movie theaters going forward, even though the shares did respond positively to this deal, the shortening of that window to 17 days from 75, I think just getting that certainty was all these theaters needed for that quick boost. But let
me just add, I don't think what you're seeing is an isolated. I mean, that's not going to just happen in one theater. It's not happening overnight, but that breaks a window that other people are going to have trouble holding the pieces together in midair. I think you're going to see these deals ripple through. This is going to become. There's a good chance this becomes the industry standard. And if you ask consumer reaction is like, well, why didn't it happen 5 years ago? We're ready to do this.
All right. So lastly, my story. What I like this, I like to go for the contrarian views often, and this one by Dr. X. Is it Dr. X or Dr. RX? I think it's just Dr. X. Why gold may be in for a fall this summer. With all of the bullishness around gold and all the movement that we've seen in gold going to record highs, he is saying that there are technical and fundamental reasons leading me to think that a pause that refreshes may await the price of gold soon. So he's not outright short, but he's saying that there's good reasons for a cooling off period. Which is more than anybody else is saying when it comes to gold. I mean, everything I've been seeing is bullish. All right, on that, let's close for the week. Thank you all for listening, and we look forward to speaking to you again next time.